there was a gentleman by the name Chandrakant Sampath. So he used to come to our office.
1 minute. The Chandrakant Sampath.
Yes.
He was part of. Wow. Hello and welcome to the latest episode of this show. My guest today, Rajeev Thakkar, CIO, Parag Parikh Mutual Fund. Rajeev, welcome to the show. Thank you so much for doing this for our audience.
Thanks a lot.
Rajeev, you're an outlier in many ways. We'll come to that later. I want to start with your early career. I believe that you're also what I call the batch of Harshad Mehta.
That's correct.
When he was at his peak, followed by the fall, then the liberalization era. Can you just recount this, for our audience, how that was an influence that it pushed me in the markets, for sure. And I've met a couple of other fund managers who also recall that time when all they could think of was going towards capital markets. What was that like for you?
So there is this concept of spirit of the times, right? So today, a young person would typically be drawn to a startup where you create a company out of nowhere, a bunch of 10 bright young people get together, have a brilliant business idea, raise some money, go for a listing and become billionaires. That's the spirit today. Late 90s, it would be to join an IT services company, go to the US and work there. The spirit of the times in 1992, when I graduated, was one, India had gone through a very tough time. We had to pledge our gold, Gulf War and rising oil prices and things like that. And then we were in this liberalization phase. Indian industrial licensing was abolished and business was being encouraged. There was this famous bull market that you referred to, Harshad Mehta. Most people remember this by the TV series. You and I have lived through that period. So a young person at that time, especially someone in the commerce field, would be naturally drawn to the capital markets. Yeah. So that's how, although by qualification I am a chartered accountant, after 92 I pursued 3 years of education, but I was drawn to capital markets from 92 itself.
Yeah, a lot of people say that being a CA, you already know annual reports. That would have come naturally to you. But in the 90s, the thing is that when the Harshad Mehta era peaked, you also had a lost decade for equities.
Yes.
93 to 2003.
Yes.
When the markets went nowhere and fixed income was giving you very stable, guaranteed returns. How did you live through that entire period before you came into the stock market? What was that like? What did you do? And I'm trying to get at the early foundational principles for you at that point of time.
So 1992 to 94, I had to do the articleship. I had to go to factories, do stock taking, do expense voucher audit, trial balance sheet audits and things like that. 94, so after 2 years one is allowed to escape to the industry. So 94 I escaped to investment banking. That was a time where, that was a period something similar to what we are seeing today, where you would have multiple IPOs launching on the same day. In a week, some 10 companies would get listed. So I was doing IPO related work. So I was the backroom guy, vetting all the prospectuses and doing stuff like that. So in short, 1994 to 2003, I was jack of all trades.
Okay.
94 I was doing, as I said, IPO related work, but within a year and a half that work had dried up. So we would go to office, no company was going public, sit in front of the computer screen, and when the boss was not looking, play computer games because
obviously
there was nothing else to do.
Yeah.
So then people said, this person has nothing to do. So I was put in corporate finance, which was effectively raising bank loans for the company that I was working for.
Okay.
So did that for a couple of years. By that time, so this was around 1995 kind of era.
Mid-90s.
Mid-90s, yeah. Mid-90s, 95 to 97.
Okay.
Interest rates were peaking out.
Yes.
So you mentioned interest rates. Government bonds were yielding 14% per annum,
correct,
semi-annual. Tata Steel, L&T, AAA names at that time were raising money at 18% per annum.
Okay.
And Reliance Capital, at that time AAA, NBFC, raised money at 21% per annum. So bonds were a no-brainer at that time. So since I had no work to do on the equity side, and then I did corporate finance, and I got shunted to bonds. So 1997 to 2003, I was doing interbank government bond brokerage.
Okay.
And 2003 was when I actually shifted to equities.
What were your early days at Parag Parikh like? And once you answer that, we'll get into the man himself.
Sure. So I joined PPFAS Parag Parikh in September, October of 2001.
Just
So this was
9/11?
immediately after 9/11. So my joining date was end September 2001. After 9/11 had already happened. So capital market environment was down and out, but I had joined the organization on the bond side as a bond brokerage.
What was the organization like then? Because I want our audience to know. They know it today as the mutual fund house, which has some pretty good schemes managed by you. What was it like in 2001 when you joined?
It had multiple activities, and those multiple activities were subscale. We were not off the charts in any of the activity. So we had a retail brokerage division, but which was limited to 1 or 2 locations in Mumbai, South Mumbai. We had not got on to the nationwide branch network that other people had ventured into. We had the institutional brokerage desk in equities.
Okay.
We were servicing FPIs or FIs as they were then called, Indian institutions, insurance companies, mutual funds. But what had happened ironically was that since we were early into equity research and we had a good talent pool, we were the raiding ground for anyone who came into India. So we lost a lot of talent to well capitalized foreign players, and that was struggling because of lack of buying power for talent.
I know that a lot of CIOs today go back to that era. I mean, the kind of pedigree that you had then, that Parag Bhai had then, was really something else.
Yes. So institutional brokerage was a challenge. We were institutional brokers in bonds as well. So that's where I joined, government bonds as well as corporate bonds. That's what we were doing. At that time, we were early into the advisory space. Of course, that time there were no direct plans. Everything was distributor plans. So we had a ARN number and we were mutual fund distributors and advising on third-party products.
Sure.
And we had a tiny PMS within the organization. So these were the multiple activities that we were doing. I joined on, as I said, late September 2001, and I was interviewed by Mr. Nimish Shah, who was the CIO of the company then. And Parag Bhai, I met after the interview was over. He said, "I'm just meeting you to chat. You are already on board, but I just want to get to know you as a person." So that was the first time I interacted with him.
What was he like?
So I had read about him before I met him. So he used to write articles in the media on a subject which I had never heard about at that point of time. That was called behavioral finance.
Oh, in 2001?
Yes.
Okay.
So at the time of dot-com boom, he did not find any fundamental value in a lot of companies that were shooting up.
Yeah.
And he would say, you should not buy it, and the stock would double, triple. He was extremely frustrated. He said, let me just take a break. And he went to Harvard to study this subject, behavioral finance.
Wow.
And he was, immediately after doing that course, he was already writing for the mainstream media. So I had read a lot of his articles before I even got a chance to meet with him.
I mean, he was that big picture long-term thinker with, goes back to Munger and Buffet. Am I right in that?
So there were various interesting people in the organization at that time.
Please tell us.
So Parag Bhai, as I mentioned, was the big picture, behavioral finance, control your emotions, opportunities will come your way and there will be no-brainers. There was a gentleman by the name Chandrakant Sampath. So he used to come to our office.
1 minute. The Chandrakant Sampath.
Yes.
He was part of, wow.
So he was a mentor to
Parag Bhai.
Parag Bhai.
Okay.
So Parag Bhai's father and Mr. Sampath were very close friends.
I had no idea about that. Please go on.
And he used to come to our office and spend a few hours in our office mentoring young analysts.
Such as yourself?
Yes, I was slightly later to the game, but so of course I spent time with him. But there were people who had a privilege of interacting with him for 5, 7 years, 10 years kind of.
So Parag bhai, Chandrakant bhai, who else?
There was a young colleague of mine, Nirjar Handa, who unfortunately passed away a few years back. So he was there. There were other people, Melvin Mehta. Then we got to know Mr. Chetan Parikh. He used to come. Mr. E.A. Sundaram I got to meet because he would once in a while drop by.
What was that experience like? I mean, we are sitting here in 2025, which is fine. At that point of time, these people were different.
Yes.
Now we know who they were, who they are,
Yes.
for those who are around. What was that experience like for you? If you were to look back and think of the founding principles that were probably laid in your head, what was that like?
So firstly, if both these gentlemen were alive today, Chandrakant Sampath and Charlie Munger, they would be almost of a similar age. And a lot of ideas that we read through Berkshire letters and through Berkshire AGMs were developed by first principles almost by Mr. Chandrakant Sampath. So this importance on management, importance of balance sheet quality, low leverage, high return on capital, all this came intrinsically to him. And this concept of even discretionary spending or the owner earning concept. So famously, Mr. Sampath was an investor in FMCG companies, and he would not look at EPS or PNL. He would look at how much they are spending in discretionary advertising, which he would term as a investment in plant and machinery effectively, because that is the goodwill that they are creating and
I
all
thought that
that.
you will say dividend, but I didn't expect to hear, on the plant and machinery. Okay.
Yeah, so he would, so there would be maintenance advertising and there would be brand building advertising to launch a new product, to enter a new geography. So he would break all that down and really have his own understanding of what real cash flow and real earnings is.
Lovely. When did you make the transition from debt to equity at Parag Parikh?
So interestingly, this happened over snacks and drinks in the evening. I am a teetotaler, but Parag Bhai would take us out to CCI maybe 2 or 3 times a week just to unwind, figure out what's happening, brainstorm ideas. So one of the evenings, we were talking about our own mutual fund distribution business, our very, very nascent portfolio management services, equity. And in passing, someone mentioned, why should one bother with equity these days? Because bonds have given 20% return per annum in the past. And the way 20% returns came by was, I mentioned 14 and 18 interest rates. What happens is, when interest rates fall, not only do you get the interest coupon, but the bonds also appreciate in value. So there's a capital gain element in that. So people who had debt mutual funds were seeing past returns of as high as 20% per annum. And equity was flat for a decade. And especially in PMS, apart from the index, you also reduce expenses. So the trailing returns were looking very, very pathetic. So I said, this is not going to last. And like, it was almost as if someone said something inappropriate, and coming from a bond guy saying this is not going to last, he said, please explain, why would you say that? I said, what was 14% per annum in 1995, by 2003, that is around 5.5 or whatever was the yield at that time, 10-year government bond yield. At that time, expense ratios on mutual funds, debt mutual funds, were very high. I said, out of 5.5, 6, whatever is there, if you remove 2%, then intrinsically it's going to give you 4%. This is assuming interest rates flatten and then they don't rise.
Because
from here, chances of them falling very significantly are low, because we are already close to inflation, and I don't see too much of a fall. Bulk of the fall is here. I said, makes sense. But I said, at this point in time, at that time, Hero Group and Honda JV was still there. So it was called Hero Honda. The stock price was 180 rupees. Previous year's dividend was 18 rupees, so 10% dividend yield.
Wow.
And expected dividend was higher. Eventually, it came out to be 20 rupees.
Wow.
So when you were buying it at 180, you were buying come dividend of 20 rupee dividend in a few months' time.
In the largest motorcycle brand in India.
Yes. And it was a growing company. And at that point in time, tax laws were such that dividends were tax-free.
Tax-free.
Long-term capital gains were tax-free. I said, in such an era, why would you not focus on equity? Because if bond funds are going to give you 4%, assuming no rise in interest rates, and here you have 10% plus
on equity,
dividend yield and capital appreciation, it's a no-brainer. He said, yes, makes sense. By that time, the long bear market has its effect. Our PMS was started in 1997.
When the early licenses were
given. But by 2003, after 6 years, our assets under management were sub 4 crores, 3.85 crores to be precise.
Wow! I was waiting for a number of 50 or 60 because even that time. Okay.
So it was sub 4 crores.
Okay.
We were having difficulty. Even from the revenue we would get to pay the audit fees, to do the fund accounting and all that. So there was actually someone had proposed, why don't we shut this down?
Yeah.
So, and people had left because money was not coming in, and there was nobody to take charge. So Parag bhai asked me and Nirjar, my colleague, would you guys want to take it? We said, sounds exciting. So that's how I shifted from
my God,
bonds to equities.
In the 20 years after that, have you ever seen a time when interest in equities was as low as that? I'm saying 2008 ले लो, 16 ले लो, 30, जो भी है. I want to give our audience a flavor of what it means when, and I know this because I was there, and when people say equities are dead, it's nahi invest karo. That disbelief is a mouth-watering opportunity for anybody who knows how stock markets work. Have you ever seen a phase like that happen afterwards? Maybe in the tech boom, I don't know.
So very briefly got glimpses of that in 2008, where people said world is ending, not because everyone is going bankrupt and all that, and not to that extent, but again world is ending kind of thing in COVID, where you said, I was on a TV panel, and all of these were happening on Zoom those days because lockdowns were there.
Yeah.
So one of my co-panelists in the CNBC interview mentioned some 15 books on the Great Depression and the Spanish flu and how large sections of the population were wiped out. And so these two occasions were somewhat similar. Not valuations didn't go to 2003 levels, but still there was panic.
Yeah, I mean, aside from the numbers, it's always about the mood and the sentiment.
Yes.
It's what people are talking about, like you said, the spirit of the times. These are once in a lifetime opportunities for anybody.
Yes.
I would assume. Okay. So let's move forward from there. Your PMS management career, what was that like? How long did that last? What did you do after that at Parag Parikh?
Sure. So 2003 was, as I said, we said equities are looking much better than bonds. So at that time, what we said is, how do we get clients excited to come to equities? Today, this fee structure would look very, very greedy, but at that time we said clients would get excited by this. So at that time, portfolio management fees were 2% per annum, charged 0.5% every quarter.
Yeah.
We said, let's go to clients and say, we will operate a PMS on a zero fee structure for you till the time you make 6% per annum compounded and with catch up and all that. So because 6% per annum was the bond yield and all that. We said, there's no way we see that bonds will do better than equities. So if we do less than bonds, don't pay us a single rupee. All of the operating expenses, audit, all the staff salaries, we'll pay out of our pocket.
मतलब कुछ नहीं तो risk free rate तो दे देंगे.
दे देंगे.
Okay.
So that's how we went to clients. So some people said, "इसमें कुछ catch है, we will continue to pay 2%." We said we are happy to. So both options were there. It was not compulsory. And we said above 6%, we'll share 25% of the profits.
Okay.
This was also the original Buffett partnership formula,
Yeah.
the original fee structure. We said we went to market with that. And at least people said if they are thumping the chest so much and saying this, we will allocate to equity. We said allocate to equity by either equity mutual funds through our wealth platform, the distribution platform, or give money to
the
PMS.
yeah.
Either way works, but please don't keep money lying around in bonds. So that's where the shift started happening. Pretty soon, so markets
Took off.
went on a tear, took off, but very soon there was this bump down the road within a year,
I think
more or
6,
less.
5 or 6.
2004 election outcome.
Correct. Yeah, the first one.
Yeah,
Lower
so,
circuit.
Lower circuit in the market because a minority government supported by communists.
Who would have thought?
Who would have thought? So the Communist Party leaders were interviewed on national television.
And they made some spectacular statement.
Yes.
I remember that. Yeah.
They said, how do we care? Market is on lower circuit, meaning stock market is anyway useless.
I think that got aired on a business channel.
Business channel, yes. So two lower circuits again. So whoever had missed out the first part of rally, 2003 to 2004, again we went and said, you missed it. You are getting a chance again. Come and buy. People said, okay. So even things like HDFC Bank and all, we cleaned out the quantity on the lower circuit.
Wow.
So those kind of things were available on the lower circuit. That was a good time. Almost 3.5 years of smooth sailing, good fun. 2007 was when the challenge really started.
Correct. But you couldn't have called it in 2007. 2007 there was euphoria, or I mean.
No, 2007 was very, very challenging for me personally.
Okay.
So what happened was, I mentioned Mr. Chandrakant Sampath, I mentioned our roots, Paraguay, all that. We were investors in companies like Marico, Asian Paints, Pidilite,
Value,
Nestle, value and asset-light businesses, high ROC businesses,
Cash.
Management quality, all of that. 2007 was when the set of companies which started going up were not in tune with what we were doing.
The same quality.
So real estate, infrastructure and commodity, these three sectors were rising. Remaining were not rising. So the heroes of the market at that time were DLF, Unitech, Lanco, GMR, GVK, Sesa-Goa, all those companies were running away and we were not participating. I was a young guy at that time, 3-4 years into equity management, and people who were client facing people in our company, if people bought mutual funds, they were okay. I mean, people who
PMS
had put money in our PMS, those people were making decent positive returns with us, but on a relative basis, we were not.
15-18 कमा रहे और मार्केट अगर 20-25 दे रहा है तो थोड़ा तो
the gap was not that much.
Okay.
Market was making 3x what we were making in 2007.
That was the wow.
So that was 2007. We had a internal meeting, very heated. Heated meaning not that Paraguay was pressurizing me, but our sales guys had taken, or RMs, not sales, we never actually sold stuff to clients. So our RMs were getting pushback from the end customer, and they were in turn venting that in the internal meeting, saying, what are these guys doing? Why can't they smell the coffee and see how the world is changing, so much infrastructure is going to get developed, take a drive in Gurgaon and figure out how much the land bank is. Why are these people not understanding how the world is moving? So I said, I am doing what I know, meaning beyond this framework that I've read about or I've interacted with some knowledgeable people. I don't understand some of these companies.
Wow.
So after the meeting, I went to Parag and said, meaning, you have an organization to run. If you think someone else is better equipped, I am happy to step down. It's not necessary. So he just smiled. He said, this is what I actually wanted to hear from you.
Okay.
He said, I have gone through the same situation. I have gone through .com. Whatever
10, 12 years ago. Yeah. When he was sitting
8 years ago. Yeah.
99, whatever. Huh?
Yeah.
7, 8 years ago. Yeah.
He said, fundamental basis, whatever I said
Was
proven wrong in the short run, but eventually it makes sense. If you had said something different, then I would have been worried. I think this is just what I want you to do. Don't get shaken by what these jokers are saying. So that's when I felt good and continued doing what we were doing. There were some redemptions. So clients went away mid 2007, in 2007. Those people came back 2008, 2009 with diminished portfolio values. That was the unfortunate part. But yeah, 2008-9 were actually good for us. We were enjoying that time.
What was the Rajeev Thakkar like 20 years ago when he was going through all this? I want our audience to kind of get that psychological feeling that Parag Bhai already went through that. And I know because the late 1990s and early 2000s, when it was very comfortable to write that Infosys trading at 200 times is an attractive buy. Okay, what was that? Fast forward to dealing with sectors which make no sense, redemptions, pressure from RM. How did you go through that?
So at that time, relatively it was easier because no one knew me. It was between me and 100 clients or 5 RMs or whatever. So these days, so it was like playing cricket with no audience and versus playing a match with a stadium full of people and live telecast and one dot ball and people say, idiot, why can't you hit a six? And especially when you are not even playing a 20-20, you are playing a test match. How does it matter if it's a dot ball?
I'm just very, it just speaks very highly of Parag Bhai that sticking through those times. See, because we are in 2007, everybody is making money, fist over whatever, over the top. If you're an asset manager, if you're a PMS or if you're a mutual fund, you have to go with the crowd. Right? I mean, that's the time to make money. And you're seeing this after 2003 when, like we said, equities was dead. It just speaks very highly of his character to stick to his guns, have your conviction. You think that that's what was happening then?
Absolutely. So, difficult to find people like him. So, some of the incidents that I hear about happened before I joined PPFAS. But Unit Trust of India, as it was then called, not the UTI Mutual Fund of India, the predecessor, was a big client for us. A lot of our revenue would come from that company. And around the time of the crisis that happened and where the sale and repurchase price was much higher than the NAV, our recommendation to clients was you should redeem Unit 64. And
this was before the scam.
Yeah, before it came out, but it was publicly known that because NAV is much lower. But people thought sale repurchase would continue as it is. So Parag Bhai went and told clients saying, if the market price is much higher than the NAV, there's no reason for you to hold on. And same thing in the case of Morgan Stanley Growth Fund, for example.
The famous Morgan Stanley Growth Fund.
So he said, NAV is the true value of if the NAV is much lower than sale repurchase price, you should take your money out. And the organization got very upset saying, and despite the risk of business going away, said, I'll say what is the correct thing and what the clients need to hear. That was one instance. The other thing was business was booming, but the risk was increasing because this was at the time of the physical share certificates. Volumes were increasing at such a pace that the operations were not able to keep up. So, bad deliveries would pile up and receivables would pile up.
This audience doesn't know bad delivery, by
Yes,
the way.
this audience does not know. So, it was something like the accelerator is being pressed and engine is overheating, which will blow up, but you don't want to lose the race, you keep your foot on the accelerator.
Sure.
He just shut his business for 3 months, saying for 3 months I'll only tackle bad deliveries. I'll not transact voluntarily with any of my customers. So he had this knack of doing what is required for long-term survival and things like that.
Where do you think that came from? Because I'm kind of, when I hear something like this, I just feel that there are two factors that play out here: reputation and trust. And those are the two things that matter the most in life in general, in whatever purchase or transaction you're doing with anybody, more so in financial markets. Because if you don't, reputation comes from trust, and trust is built, it's like a same thing. And it just seems that he had that thing very early on, and the character, the integrity, it just says a lot. Do you think that's one of the factors?
Yeah. So let me give the downside to that also, or a flip side. Most things which are positive have a small downside.
Always.
Let me portray both the sides. He had what one would call the worry gene.
Okay.
So conservatism, not to take extra risk, which led to survival. So like they say, in the forest, people who worried when there was a rustle in the leaves and who ran away are the people who are our ancestors, because they survived. Someone who was brave and said, no, it's just wind, probably got eaten by the tiger. So he had this worry gene. He would worry about what are the things that can go wrong. That helped us survive over 45 years and grow. It also led to missing out on some trends. So the thing that I mentioned, he focused on bad deliveries and shut the business. That was the very same reason the focus on survival, conservative approach to business was the same reason he did not expand nationwide.
Okay.
Now, when DMAT came in and when computerized transaction came in, probably that was being over conservative. So it led to missing out on one trend. Then acting in client interest and not encouraging gambling tendencies. We never had a F&O desk.
No derivatives.
No derivatives. So which led to severe market share loss in brokerage, and we eventually exited retail brokerage. So it had both aspects, but largely it's helped us in terms of staying true to who we are.
Folks, if you're wondering why we are spending so much of time just on Parag Bhai, you should know that these are good behaviors that last through cycles. It's not just about him. The man represented certain values that will definitely hold any long-term investor through various kinds of market cycles. Like Rajeev was saying, that they come at a cost, but I think over the longer term, one is still better off if you stick to your principles. Yes. Okay. Post GFC, what happened after that? What was, I'm just trying to set the stage for 2013 when the mutual fund actually started. These last 4 years, post GFC, what was that like?
Sure. So, in the midst of GFC, we had this idea that we should transition from a PMS structure to a mutual fund structure.
Okay.
And that we came at this decision through maybe 5, 6, 7 angles, and each thing was saying mutual fund is a compelling structure, one should not continue in the PMS structure. PMS client onboarding was becoming increasingly onerous. So, to onboard a PMS customer, we needed a PMS agreement, DMAT account opening, BSE account, NSE account, stock brokerage account, custody agreement, and for NRIs there would be more paperwork, PIS and all that.
Maybe throw in a power of attorney there?
Yeah, power of attorney as well. So, local resident would need around 75 signatures, wet signatures, and at that time there was no digital onboarding.
Yeah.
NRIs would require around 100 signatures, and it would happen sequentially. First open the bank account, then register the power of attorney. After the bank account is opened, then the demat account would be opened, then the custody account would be opened. Onboarding would take more than a month. This was one part. At that time, the entry level for a PMS was 5 lakh of rupees.
Correct. Yeah.
Which went to 25 lakhs, which went to 50 lakhs. This was visible. The media discussions, regulatory discussions had started. We said increasingly we will serve only the ultra wealthy, we will not have the existing client profile. From that time we were interested in global diversification, global stocks, which was not permitted in PMS.
Correct.
Even today it's not permitted in local PMS. One has to set up a gift PMS to do global investing. So global investing was not permitted in PMS. Tax laws would change, was there in the first direct tax code, which was introduced in the parliament. So from various aspects, so mutual fund was a simple paper, one single form onboarding. For various reasons, we said mutual fund is where we want to go.
Okay.
The thought process started in 2008-9, but it took almost 4-5 years for us to actually operationalize that.
Let's jump into this here. I mean, I'm trying to understand. You launched in 2013. I just had a look at your fact sheet of that time. Of course, I think the fund was called Long-Term Equity Value.
Long-Term Value Fund, yes, that was the first name.
22% in foreign stocks. And that also diverse, like Nestle, 3M. 2013, if I remember correctly, was what, taper tantrum? Yeah, roughly there's some Europe crisis going on, US, something or the other was happening at that point of time. I don't think these stocks were even cheap. I mean, Nestle, I think globally, I don't know. So I'm just trying to arrive at the fundamental logic of investing in foreign stocks in 2013.
These were reasonably cheap at that time, and they were far cheaper than the Indian stocks, equivalent Indian stocks. And at that time, companies like Nestle were giving 5 to 6% dividend yield. And 3%, this is dollar, Swiss franc kind of dividend yield. And if you add 3% currency depreciation, we were getting around 8-9% kind of predictable cash flow returns.
Without even capital appreciation.
Without capital appreciation. And plus, we have said going global is about 2 or 3 things, not necessarily about capturing maximum returns. One is, it gives you lower country specific risk. Now, no matter how good our country is, there are some factors which will affect only India. So this Pahalgam attack, Operation Sindoor is an India specific event. Global stock markets get affected, but not to that extent. Demonetization or a GST introduction are country specific events, both positive and negative. So on the positive side, a surprise tax cut that was announced, corporate tax cut. Indian markets went up, global markets did not. But when you have part of the money abroad, it evens out the volatility. The ups and downs are not that severe. So that is one reason to go global. Second is, while Indian market is well diversified, still there are certain gaps in industry segments which we don't have here. So electric vehicles, a company like Tesla or a BYD, these are outside our Indian shores. Google, Microsoft, Facebook, Amazon, Netflix,
not available here at
not
all.
Available in India. The innovator companies of GLP-1, Novo Nordisk and Eli Lilly and all are not Indian companies. So there are segments which are not available in India. So if you want to invest in them, you have to go abroad, TSMC or ASML, Nvidia. So all of these are foreign companies.
Where do you build research capabilities? I mean, it's not like, you're a foreign, like a city or a whatever it is who has branches in the entire planet. So 2013 is also a time when, your mutual fund AUM was not as large as it was today.
Yes.
Foreign brokerages, I don't know, would have taken you seriously or not. How did you build that capability to?
Leave aside foreign brokerages, Indian brokerages were not taking us seriously. So we had a mid-sized Indian brokerage who we said, we are a new mutual fund and we would like to work with you. They condescended to say, ठीक है, कर लेंगे business. The RM for us was from their HNI desk.
Not even Insti.
Not an institutional broker. So yeah, so we were not getting foreign sell side research, but we had over the years networked with a lot of people who were working in various sectors. And again, one, within India, we don't want to cover each and every company. We filter out promoters, managers who are not, according to us, people who we want to partner with. We filter out sectors which across a cycle have not generated a decent return on capital.
Okay.
We filter out very, very highly leveraged companies. Utilities and banks are exceptions, but otherwise we don't want too much leverage.
Okay.
So within India, our coverage is somewhat limited, and those same analysts would cover their global counterparts.
Okay. That made sense. Yeah.
So increasingly, what we say is your country of listing may not matter so much, because if you are today buying Tata Motors in India, you cannot not have a view on Jaguar Land Rover. If you are buying Bharti, you need a view on their African operations.
Very interesting.
If you are buying Hindalco, you need to have a view on Novelis. And even if you are just buying the Indian company, let us say if you are an analyst covering Wipro, Infosys, TCS, all the analysts will log on to a Cognizant and a Accenture conference call, and most likely will have a view on those companies. We said, let's structure our research on sectoral lines rather than geographical lines, and let's go where the opportunities lead us.
Very interesting, because you're talking 2013. All these acquisitions were in 2007.
Yes.
Bharti and whichever, I think it was.
Tata Steel, Chorus, Tata Motors,
all of them
Land,
happened at that. Rajeev, I got the foreign story, diversification. It makes a lot of sense about how a lot of Indian stocks are also going global. And like you said, how you get access to sectors that are not available in India. But then you have pushback from a lot of people, fund managers included, that India's growth story is the best on the planet. You have to be, then you have to be in India, fastest growing economy in the world. How do you reconcile with that?
One of the things I would urge people is, firstly, don't look at country of listing as the country of operations. So if you want to buy or participate in the online travel agency business in India, the company is not listed here, the company is listed overseas. Two large auto companies in India have parents overseas, and their overseas subsidiary, overseas parent companies are at such low valuations. If you ascribe the Indian valuation to that piece, rest of the global business comes very, very cheap or almost for free in some cases. So that is one. Second, the GDP growth of India may not translate uniformly across sectors. So if you are in, let's say, oil and gas exploration or a global commodity like steel or zinc or copper.
Even crude maybe.
Yeah. So those cycles are global. Production depends on your oil well, not on what is India's GDP. So the opportunity may come abroad. Then the other factor is to keep in mind is GDP growth may not translate into profitability. So Benjamin Graham said this decades ago. He said obvious prospects for physical growth do not translate into obvious profits for investors. Now there are real life examples from India itself. Mid-90s, if you were to look at the sunrise sectors of that era, private sector airlines and telecom would be two sectors one would think would make a lot of money. Indian Airlines was the monopoly operator for domestic civil aviation. Private airlines came in. Not a single company from that era is alive today. Indigo came in much later. All of them went bankrupt. Telecom companies from that era, probably only Bharti Airtel is around. Vodafone Idea is around in some form, but hasn't made money historically.
Everybody
so
else
far.
was either consolidated, bankrupt, whatever.
Yeah.
Surrendered the license.
Volume growth does not translate into profitability. What matters is pricing power, balance sheet, competitive intensity, uh, management integrity and competence. Various things have to come together for you to benefit. Now, if I say this sector is going to double in next 5 years, it may seem like an attractive place to be in. But if I say currently 3 players are operating in this sector, 3 more will enter with very ferocious intent and
Balance sheets, maybe.
yeah, with strong money power, then it may not look that attractive. So one has to balance it out. Our northern neighbor, China, has had phenomenal growth over last 30 years.
Yeah.
Their equity markets has given a dollar return per annum, which is sub 2%
Wow.
over 30 years.
Over 30 years.
Yes.
Okay.
So it's not automatic that, and they have brilliant companies out of there.
Yeah,
so
yeah, yeah.
they have the Tencent, Baidu, Alibaba, BYD, Cattle, all sorts of companies are there, Huawei. But people have not made too much return out of that market. So one has to be stock specific ultimately, because you can't rely on GDP tailwind to make money on your portfolio.
Okay. Early years of fund management, right? 2013 to, I don't know, 2018 maybe, you just pre-lockdown. What was that like for you? Because if I remember correctly, 2006 to 16 might not have been the lost decade like 93 to 03, but 2006 to 16 was FD returns. Even though we had a new, we had a change in government in 2014 when the markets went up. What was that like? Because your fund outperformed every year. Each and every year, I think when you started, except maybe for maybe 1 or 2 years in the middle, what was the early experience like? Because I think the kind of stocks that you invested in domestically were also very different from where you are today. Let's talk about that.
Yes. So we said we will go where opportunity takes us. We will go across small cap, mid cap, large cap. We will go across sectors. We will go across geographies, India plus overseas. We will not bother too much about what is there in the index.
Okay.
On first principle basis, on fundamental basis, an opportunity should make sense for us. So there were companies that did well for us. There were companies that did not do well for us. So there used to be a toll bridge operator which due to legal reasons had a change in business model. There were 2 or 3 stocks which did not do well, but overall in that environment where there was tremendous amount of uncertainty in the marketplace, broken balance sheets of banks, broken balance sheets of corporates, lackluster growth. So we stuck to things that were looking reasonably good. And the year where that you refer to, 2017, where we did not do well, was when again there was a rampant up move in small caps.
Yes, yes.
So we were not participating in that in 2017. So by end 2017, January 2018, we were in a lot of cash. We were as high as 30%. And then 2018, there was this big crash in the small caps. So that helped us navigate that year. So broadly, we were fine in that sense.
You also had a very big event in terms of Parag Parikh passing away. What was that entire event like?
So more than the business side, it was a personal shock. We were in the car, I was driving the car, there was an accident, he passed away. So so one is Mrs. Geeta Parikh was injured, so her recovery and health was something we were focusing on at that time, and lot of things happening on the personal side. Apart from that, the worry was that end of the day mutual funds are open-end products. Client can say, give us our money back. So our thing was, would clients want redemptions, or would there be redemption. So we were prepared for that. Some colleagues had to, this happened on the weekend, had to sit through the night to figure out, in case there are large redemptions, how will we honor them and how will we generate liquidity.
Just for our audience, the year was?
This was 2015.
15, yeah.
This was May 2015. So we were prepared from that side, but to our greatest surprise, there were no redemptions.
Wow.
Obviously, the small redemptions which anyway keep happening, those would happen. Someone would have needed money, but because of the accident, because of Parag Bhai's passing away, he had so much goodwill and people had trust that the organization would carry forward his values and his vision. So at that time I was in the US. Neil also had to come over for the funeral and all that. Once we came back to India, we started meeting people. People had two things to say: condolences, let us know any way we can help. And they said, we are very happy with the organization. Some of them actually had checks ready, so instead of redemption slips, they said, we are adding more money, meaning we are not worried at all.
So this is 2015, right?
2015.
So the mutual fund business is what, 2 years old?
Yes.
You had a PMS or you had wound that down, or what was that like?
So all the PMS clients were migrated to the mutual
fund business.
Yes.
So, and there was broking at that time, or there was no broking?
Broking had almost shut, or we had shut the operations, we had surrendered the memberships.
The reason why I'm asking this is because if it was any other mutual fund that had just started from zero in 2013 and in 2 years would have such an event, I don't know what would have happened. I'm just thinking that whether this was the cumulative trust built over the previous, 20, 30 years?
Yes.
That kind of really, you think that was one factor?
Yes. So, most of the early clients in the mutual fund were the PMS customers. So, although in the mutual fund structure they were there only for 2 years, these are the people who we met in 2003 saying it's a great time to invest in equities, who we said, okay, 2007 we are not chasing the market, who saw our behavior in 2008 and 9. Those are the people who stuck with us and added money.
Where does this investor behavior come from? See, you know this thing called the investor gap.
Yes.
Which is the fund return versus the investor return, and that is ascribed to investors doing random things, buying, selling, up, down, this, that. Hey, here I have an example of people who just stuck with you.
Yes. So I think it's a self-selection in a way. Birds of a feather flock together, or whatever. A person who wants to do expiry day options trading is not going to come to us. A person who wants to build wealth over decades will find this as a likely home and will automatically get drawn towards a fund or an organization like us.
Okay. Again, folks, investor behavior, you can't get anything better than this. See, also, Rajeev, one thing is there that 2013 to 2015, 16, 17, whatever it is, AUMs were also, I think, you would have reached about 500, 600 crores by...
2015 we were at 650 odd crores.
Yeah.
May 2015 we would be around 600, 650 crores.
Yeah. So, cash. I want to talk about that because our discussion so far, it's just been anti-consensus. Okay, 1999, 2000, Parag Bhai said, don't buy IT stocks. Faced the heat, paid the cost, proven right. 2007, hot sectors, faced the heat, proved himself right. And 2013, goes and invests in international stocks when everybody is India focused. Again, same thing. Cash. Let's talk about that. What is behind this? Because almost every fund manager that I've met is very clear that we don't take cash calls. PMS, so I don't think can even do cash calls given the structure of at least whatever it is, or it's possible. It's possible. Okay. Walk us through this, I don't know, cash obsession or whatever you want to call it.
So this is not my phrasing. This is someone else's phrasing. I don't remember the name of the person, but otherwise I would have attributed the quote to him. He said that cash or money in the bank account is a unspecified call option on an unspecified asset at an unspecified strike price at an unspecified time. So, you don't know which stock is going to fall, you don't know when it is going to fall, you don't know at till what price it is going to fall, but you can exercise that only if you have money in the bank account. If you are deployed to the last rupee, that opportunity is irrelevant to you. So, this is a long form statement. A short, very succinct statement was given by Mr. Chandrakant Sampath. He would keep money in bank FDs, which can be broken at will, and you get overdraft against bank FD if you so choose. And he was in the higher tax bracket. I, in my naive thing, saying you can invest in tax-free bonds or other things which are sellable. He had just one question: can you write a check? I said, what? I said, on a tax-free bond or on a debt mutual fund, can you write a check? I said, no, you have to redeem it and then you can write a check. I said, that doesn't help me. When the opportunity comes, I want to be able to write a check. I don't want to wait for anything else to happen. If I can write a check, I can avail of that opportunity.
It's worked for you so far.
Yes.
It's not like previously when you had said about lost opportunities that had happened in the business. That's not been the case so far with cash, this kind of a call?
So, last 1 year, headline indices are 0 to marginally negative, maybe 1%, 1.5% negative. Cash, money in the bank has given 7%, 7.5%, whatever.
What are some points in your, I mean, we've already spoken about this, but I want you to kind of summarize, looking back at your career, at those toughest moments in your investment decisions that really tried and tested your character. Let's talk about that for a while. What was that like?
So, a lot of people ask about 2007, 2008. That was actually easy, meaning,
as you said,
which was like, the good thing about the organization is that you have backing of at least one of your bosses. So, I say every fund manager has 3 bosses. One boss is the organization CEO or the promoter or whatever you call. The second boss is the distributor, advisor, media, whoever influences the purchase sale decision of the end customer. And the third boss is the end customer. Any 3 of them can fire you at will, saying you are no longer required. Now, in this organization, you have your boss having your back, saying, I am with you. The customer may redeem or may give you more money, but as long as you are following the agreed upon process, we are standing with you. So, that is easy.
Okay.
So, 2007 was not that difficult.
That tough, yeah.
The toughest period for me was 2020. Not from a financial perspective, it was this unknown fear around the disease itself. So, financially, I knew that if the world is going to survive and if humanity is not wiped off, it's a great investment opportunity. The fear was in family, you have elders. We had some close relative who had undergone a transplant and who was hit with COVID. Now, whether that person would survive the COVID infection or not. The sheer fact of being locked up in your homes, not able to go out in sunlight. So, 24/7 news cycles. So that personally was challenging more than the financial markets as such. So, that was one period, and of course, without question, 2015, the passing away of Parag Parikh.
Yeah. I want to talk about now the post-pandemic boom that happened in your fund, which has pushed it to AUMs of, I don't know whether you had 10 years ago, you could have thought that you would be at that.
Absolutely not.
What do you think happened?
The optimistic scenario was nowhere close to where we are right now.
two questions. One is, what do you think really worked? And second is, do you think, where does this go from here for you?
What worked for us is what's working for every D2C brand in the country.
Okay.
This would not, neither would PPFAS have happened or neither would D2C brands have happened 2 decades back or 3 decades back. So, the rails were not there for the train to go through. If we were a mutual fund in 90s, we would have had to open branches all over the country. We would have had to employ an army of people filling out paper forms, doing in-person KYC, collecting checks, all of that. What changed is internet happened, Jan Dhan Aadhaar Mobile, Trinity, common KYC, internet banking, all of that. So, what happened was a customer who over the years has been onboarded by SBI Mutual Fund, ICICI Mutual Fund, HDFC Mutual Fund, the large pioneers in the field, they have onboarded the customer in the mutual fund ecosystem. They have done the KYC, that KYC resides with the KYC registration authority. We just have to ping saying, is this PAN number valid?
Valid.
If this PAN number is valid, we can onboard the customer. So, this is one. Second, the clear distribution ecosystem that has been built, the ARN holders. So, now there are 3 tracks. One is the ARN track, which is the historical track where mutual fund distributors help onboard customers, give incidental advice, all of that. Then there are all these platforms. So, to an extent, we have also benefited from platforms like Zerodha Coin, Kuvera, Grow, all of the
platforms,
ET Money, Paytm Money, all of the platforms which enabled DIY investors to onboard.
Sure.
And the internet websites and the mobile apps that we have. So, someone can go to the App Store, Play Store, download our app and get onboarded. So, this was not possible 2 decades back. So, I think it's a thing of getting discovered and then ease of getting onboarded largely.
What happens from here? Literally there's no other mutual fund of your scheme, there's no scheme of your size.
So, that will, one, that is by design at the industry level, because people want to launch diverse strategies with diverse set of managers. It's also, in terms of pure economics, it makes sense to have more schemes rather than concentrate in one scheme. So, to that extent, we get seen as a large one, whereas the active equity AUM of the larger fund houses is maybe 5, 6, 7 times
what you are,
what we are. So, partly it's because we run limited number of schemes, limited strategies. The other thing is plenty of people are coming in. So, today we have 47 fund houses, 7 fund houses are already in pipeline. So, we will reach 54, 55 very, very soon. And you are having large players, small players, all sort of players coming in. So, there are the leaders in the brokerage ecosystem who are here. Zerodha AMC is there, Angel One, all these players are coming in. Geo BlackRock is coming in. You have people like Capital Mind, Alchemy, Abacus, and various people are coming in. So, it will be exciting, lot of product launches will be there, lot of competition will be there. I don't think it will be a one-way ride, there will be ups and downs.
You're kind of welcoming competition, saying that that's going to be a good thing for us.
Any growing sector will attract newer players. And unlike banking where licensing is very strict, SEBI has been reasonably welcoming, AMFI has been reasonably welcoming of newer players. So, I would expect people to come.
I just remembered one thing on the point of cash is that given the kind of proportion that you have, the high holding of cash, it's obvious that timing plays a big role. Like you said that, you know, something will happen, you don't know when and how it will happen, whether it's a fall or whatever. So how do you, in your investment process, how do you make sense of this versus say something like position sizing? Like when that moment comes, you need to be in a good position for that to actually work for you, because otherwise deploying that cash will not. How does that process play out?
Sure. So, when we set to create a portfolio, we don't start out with a cash number in mind.
Okay.
So, let's say today if I were to start from scratch, I would not say I want 22% in cash and then let's deploy remaining 78%. I would say I want these companies in the banking sector with these weightages. I want this much weightage in pharma with these companies. After I have run out of all the ideas and the weightages I have in mind,
Yeah.
whatever remains is the cash. If I find adequate ideas, cash will be down to 2 or 3%. Because 2 or 3% we typically keep to meet inflows, outflows, so that we don't have to buy and sell all the time. So today it's because we don't have enough exciting ideas. So some people say, why don't you increase weightage in your existing positions? But then you end up overexposing yourself to ideas or sectors. So if I have a 20% upper cap in mind for banking, for example, then taking that up to 25% does not make sense. Or if I want a diversified pharma basket with one quarter weightage in a company, I don't want to make individual company weighting 2 and 3%.
Yeah.
So we start with that.
Okay.
Typically, in terms of portfolio weighting, we want to strike a balance between extreme concentration and extreme diversification. Extreme concentration, if we were allowed and if we put 100% of money in one stock, if that stock fell 50%, portfolio would fall by 50%, which is not acceptable.
Yeah.
At the other end, if we put 0.5% of our money in the best idea that we have, even if that idea triples, we'll make only 1% return at the portfolio level. So somewhere in between 3, 4, 5%, 6, 7% is the target weight that we have.
Sure.
Given the size that we have, we will have slightly larger number of small cap companies in the portfolio,
Sure.
but otherwise nothing changes.
And flexi cap is the place where you want to be. It gives
Yes.
you literally that amount of flexibility across. You think that is a sweet spot, even in terms of where the Indian market is, where the valuations are, where, you know, would that be accurate?
That's correct. So today people argue, are valuations in small and mid cap elevated, or is this sector elevated? So if we were running a market cap fund or a theme based fund, then we are constrained.
Yeah.
Today we can go where we find the opportunity. Again, there is discussion happening in the media, at AMFI, at SEBI. What should be the criteria for classifying a stock as either large cap, mid or small? Now, everyone has their opinion. We are on the sidelines. How does it matter? We can buy all three of them.
Yeah.
So it helps a lot in terms of not having to worry. So the market cap based funds have to periodically rebalance their portfolio just because the stock moves from one bucket to the other bucket, even though fundamentally nothing has changed in the company and they would want to own it. If I am running a small cap fund and the company becomes a mid cap, then I may be forced to sell it somewhere down the road. I'm saying, why worry about it?
Why worry about that? Okay. Last few questions now, Rajeev. I want to talk about disruption, right? What does that look like today for you? I mean, you mentioned about how so many mutual funds are coming, but outside of the capital markets industry in India in general, could be AI, could be anything. How did you get disruption now? How do you think that's going to impact us going forward, whether it's the markets, companies, sectors, economy?
Sure. So I think Jeff Bezos has put it beautifully when he talks about retail. I am broadening that statement to general investing or to the world. He said, people keep asking me, what are the things that are going to change in retailing? And I tell them that I don't worry too much about what are the things that are going to change in retailing. I worry about, or I want to focus on things which are never going to change. So people are never going to tell me, I wish your prices were higher. They will always want lower prices. They will never tell me, I wish your delivery speed would be slower. They would always want delivery quicker. They are never going to tell me, I wish there was a fewer variety of products on
sale,
your
yeah.
portal. They will want good variety. They will want good quality. They will never say, I wish quality was poorer. So if we focus on things that are not going to change,
Yeah.
that helps us last long. And even things where one thinks that things have got disrupted, the core human need actually is the same.
Same.
When we moved from horse buggy to internal combustion engine to arguably electrification of the transport, essentially people want transportation rather than. So, if one is invested in the core need of the customer, and if we are invested with agile managers who are not asleep at the wheel and who are working towards transitioning the company, I don't think one needs to worry too much. Entertainment has moved from, let's say, linear TV to streaming, but end of the day, the content is more or less the same. Now, people were watching IPL on cable TV,
Or
they
they're
will
watching
watch
on apps.
on streaming.
Yeah.
The managers have to be reasonably competent to see the trends and adapt.
Okay.
So,
Okay. Couple of questions on investor behavior. If I just own nothing but just Parag Parikh FlexiCap fund, I don't believe in diversification. I'm chasing the one asset or one investment that has given me the best returns in lower volatility over the last whatever 10, 15 years. Is that enough for me, or should someone diversify?
I can't talk about what other people should do, but that is what I have done, or what a substantial portion of my colleagues. And so we invest
Skin in the game.
skin in the game,
Yeah.
over and above what SEBI mandates us. What one has to realize is, although it will be one mutual fund scheme, but underlying there are 30 well-run companies.
Yeah.
So across sectors, across to certain extent geography, across market caps. So we are comfortable, but individual investors have to take their own decisions.
Do you think this generation of investors, because I don't think in the history of India's capital markets, whether it's stock market or mutual funds, have we seen this large number of people come in the last 5 years as ever before? What do you think about this generation? Do you think it's different, it's the same, or any thoughts?
There are both signs. There are signs that this generation is much better than earlier generation. At the same time, there are signs that it is not. So it's a barbell kind of thing. I think probably both are simultaneously true.
True. Yeah.
There is one segment which is terrible, and there is one segment which is phenomenal. So let's take the terrible part first, which is there in the SEBI report
Derivatives.
of derivatives. Now, people with self-declared income of up to 5 lakh rupees, up to 10 lakh rupees, are bulk of the people who are losing 1.5 lakh rupees per year. Now, if you blow up anywhere between 30% to 60% of your annual income on gambling, then it's not a great thing. At the same time, there's a large segment of people who have understood the power of equities. Some of them may have understood it because they got ESOPs with their employers or their foreign employers if they are working in GCCs. They have understood the power of SIPs, they have understood the power of compounding, and they are coming in.
Sure.
So both these behaviors are simultaneously coexisting right now in the market. To your point about post 2020 investors, one will have to hold the judgment. These people were courageous to invest when markets were down, plus marks for that. They haven't seen a sustained downturn, which is the question mark. What will they do when markets go nowhere or slightly downwards over 5 years, over 10 years? We'll have to see. Last 1 year, I think behavior has been more or less responsible. I don't think they have behaved irresponsibly.
I think as far as your experience and whatever you narrated so far on this episode goes about how to survive periods when markets go nowhere, and you have seen that.
Yes.
Staying with conviction, how would you advise them? Let's say that from here on, when this episode airs, for the next 5 years, 3 years, 5 years, the markets go nowhere. Now that we have, some kind of crystal ball gazing machine, what's your message to the audience on what they should do if the markets go nowhere?
The first thing seems very, very elementary or basic is getting your asset allocation right. In March 2020, I personally know of people who had to redeem equity assets, which they did not redeem out of fear for markets. They did not redeem because they thought there's no future for equities. They had to redeem because they lost their jobs and they did not have emergency corpus and they needed that cash flow to survive. So, having proper life cover, health cover, building an emergency corpus, matching your investment horizon with your financial goals. If you have a goal of buying a house 1 year down the road, you have no business having bulk of that money in equities. It should be in short to medium term debt instruments. So, I think those are the mistakes people make which create these unforced errors in tennis terminology. No one is forcing you to redeem in a bear market, no one is forcing you to buy at the top. But if you don't get asset allocation right, you end up making those errors. The other thing is do a pre-mortem like we are doing right now. Assume that next 5 years, 10 years, markets will go nowhere. Are you still excited to come to equities? If the answer is yes, please do. Enormous amount of wealth is yet to be created.
Enormous amount of wealth is yet to be created. Yes. On that note of positivity and enormous wealth, that is a wrap on this episode. My guest, Rajeev Thakkar, CIO, Parag Parikh Mutual Fund. Rajeev, thank you so much for doing this for our audience.
Thank you for the opportunity.
Thank you.